Hey guys, thank you so much and welcome. I can see we've got a lot of people jumping on here a little bit early, which is fantastic. And I hope you guys are as excited as I am because this webinar that we're about to do today is one that I personally have been waiting for a very, very long time. Before I play the recorded portion here, I just want to give everybody a little bit of backstory here and why this is so important to me personally. So in 2008, as the market was crashing around us, while it was devastating to a lot of people, including family members of mine, friends, and so on and so forth, it also created great buying opportunity. So as an investor, I saw this around me, and I saw properties in California at that time in the Bay Area going for, in some cases, 20% of what they were going for at the peak. I said, this is astonishing. And being a cash flow guy, so, this is something that they're still renting for effectively the same in Bay Area, California. Anybody who knows this area knows that the rents are astonishingly high here. So the cash-on-cash returns were just out of this world. So I said, I need to find a way to buy as many of these properties as possible. And working with partners, family, friends, we were able to do that. And I will never forget when I was first told about a self-directed IRA. It was like a light bulb went off in my head when I realized that my family and myself, we could actually access the money that we had felt like had been locked away for all of these decades in these retirement accounts. And we could not only access it without the tax penalty, but we could actually utilize it as we chose to utilize it. And in our case, that was to buy income-producing properties. And but you can also use it to buy precious metals, stocks of your own choosing, so on and so forth. And this, to me, as somebody that now despises the stock market, I had seen firsthand at that time in 2008, 2009, the market crashing, and all of the people that had been the so-called experts, in some cases literally jumping out windows in Wall Street or being sent to prison or whatever it may be. It was a bad time. And the thought of being able to have that freedom and power, as you can see on the slide there, to be able to invest our money that we work so hard to make and to save the way we see fit, that sounded pretty appealing to me. So all of the webinars that I've been a part of the last year plus, that many of you with us I know have been on as well, you've probably heard me mention on almost every webinar we've done about the power of a self-directed IRA, because what it does is it allows you to make the decision for yourself on how you want to invest in your retirement. And it allows you to at least have the opportunity to be able to get some of these amazingly high returns that other investment vehicles outside of the traditional mutual funds are getting. As you'll hear me say on the recorded portion of the webinar, you're not going to ever get a 50% or 40% return on a mutual fund. It's literally set up that is not possible. So I'm not saying that you're going to get 40 or 50% when you do it yourself either, but at least it's possible. And at least you have the opportunity to make judgment calls and adjust to what you see happening in the market with your financial future, and not just put it all in the hands of the big banks to let them control your future. Because obviously we all know that one thing I think everybody can agree on is the big banks do not care about us. I think we can all pretty much agree on that. So with all the talk about it on all these webinars, we have never had the opportunity until now to be joined by an actual expert in this field on self-directed IRAs. And so that's why when the opportunity came to me to sit down with Jay Goldblatt, who is one of the nation's experts in this field, I was just ecstatic. I knew that you guys in my network would all be ecstatic about it as well. We recorded what you're about to hear yesterday. This is the first time it will be aired, and I have to tell you that Jay is such a great guy and such a warm guy, really cares about education. You're going to get a lot out of this, but I want to make sure all of you please stick with us through the entire recorded portion as well, because the real value I think you're going to get today is in the live Q&A, because that's when we all get to personalize it. That's when we all get to ask Jay whatever we want about our own specific situation or specific questions or goals that we have. So again, guys, thank you so much. We got a ton of you on here early, which is great. The webinar is going to start in about 2 minutes. I'm going to let everybody trickle in. I will then start the recorded portion. Any questions you have, again, type it in the chat box. We will answer 100% of them on the live Q&A. I'm also going to reveal at the end of the recorded portion some hot opportunities in the real estate sector that, of course, you could invest with that are extremely secure as well with the self-directed IRA that I think you'll enjoy. But the meat of this, guys, is I hope this really educates all of us, including myself, on how we can unlock our top earning potential, because that's really what this is all about. So thank you again, guys, and in about 150 seconds, we will play the recording, and I hope you enjoy it. Okay, guys, thank you so much as always, and welcome. This is Stephan Piscano with listedby.com and the Real Estate Networking Group. And guys, you have joined us today for a very, very special event. This honestly might be the webinar that I personally have been waiting the longest to do and looking the most forward to as well, because today, in just a moment, I'm going to be joined by one of the nation's experts on self-directed IRAs. And those of you that have been on pretty much any webinar that we've done, especially for the last year, know that I have long been a fan of self-directed IRAs and the level of control that it gives all of us over our financial future and decision-making capabilities that just aren't there if you're putting our money in the shroud of ignorance that can be the stock market or mutual funds. So with all the talk about self-directed IRAs that we've done, we've never had an expert on to discuss this topic. We've never had anybody that can really show us, step by step, how can we utilize this strategy for ourselves. So really excited about that, guys. We're going to have a live Q&A session at the end as well. So any questions that you have, make sure you type those in your chat box, and we will give 100% of them answered, because it's a topic that I know a lot of you have been excited to hear about as well. So without further ado, I want to welcome Jay Goldblatt with me. And Jay, how are you?
Great. Hi, Stephan. Thank you so much for having me. It's an honor and a privilege to be part of this webinar. I am very excited to speak with you today and to help as many people as possible that are listening. So doing great. How are you?
I'm doing great, my friend. I got to tell you, for me, it's like having a rock star on for me, my friend. I get a little bit giddy when I think about self-directed IRAs, and you're the guy that honestly we've all been waiting for. So I'm pretty excited to chat with you. I know that we're going to have a lot of great questions too. And I know from talking with you offline that you are the perfect guy to be able to present this material. And I know that you really care about education as well, which is what our mission statement is here listed by. Before we get into the meat of today's conversation, could you just give us all your personal background and kind of what got you to the point you're at today with real estate in general?
Sure. Thank you. Well, briefly, I had beginnings with real estate with my family. My father had a home improvement business. And so I grew up with that. For 30 years, he built it into something that, in our area was well known and well respected. But the funny byproduct of that is that by growing up with the home improvement contractor, other kids get, certain toys, bikes, balls, whatever. We got 2x4s, paneling samples, spare shingles, whatever it was, and we, built our own stuff with it. So that was my first taste of real estate. And of course, he also bought some properties, fixed them up, and had some tenants, with rentals, and it really opened my eyes to what was out there, even at a young age. When he passed on, I took over the business and ran it, and then after a good stint, we sold the business, and I moved. I moved to right here where I am now, Rockland County, New York. It's about an hour north of New York City. And got into the insurance field, and was doing that for close to 10 years. And then a good friend who I'd known for a while came over and just asked me how things are going, and had just a neat business that he was running, and it's booming, and he needed some help. He's so busy. And I said, well, what is it? What are you doing? And he said, well, we're doing self-directed IRAs. And like everybody else who hears that for the first time, my head just turned sideways. I said, huh? So what is that? So I knew about IRAs, I knew about 401ks and all that, but what was this? So he went on to explain to me, he gave me some paperwork, to read over, some very interesting information. After about a day or two, I got it. It clicked. And I said, this is it. I've got to get into this. This is really exciting. So I, moved on from my other career and shifted here about 4.5 years ago. And it's been a great ride. It's really been pretty much the whole way an upward growth. And I've just learned so much. I've talked to people from all over the country. And I think by and large, the most gratifying thing that I've gotten out of being in this position, which I thank God for, it's a real gift. I think that the greatest thing I've gotten out of it is the gratification knowing that I've helped so many people free up their retirement money and be able to do something that they want to do, that they understand, and that they can make more money from, and not suffer anymore from the whims of Wall Street. And so to me, it's just been so gratifying to help thousands of people, literally from every state of the country, for the last 4.5 years. So I'm very happy you found me here, and happy to help you and Equity Build and to teach even more people about this.
That's awesome, Jim. Well, and you used the word there of free people up. And I think that in my mind, that's the perfect terminology to use, because you can see we got on the next slide here. When I think about a traditional IRA or 401k, what I think about is people, and I hope nobody gets offended by this, but us all, because we've all done it probably, blindly putting our money into usually a mutual fund of some kind, where the fund manager half the time or more than half the time is investing in other mutual funds, and it goes so many levels deep that the old fund manager doesn't have any idea what actual companies they're investing our money into more often than not, because it goes so many levels deep. And it's an extreme lack of control. And when I think about the Wall Street institutions having that kind of control over my money that I'm working to make and my financial future, to me, that's terrifying. And so when we think about a self-directed IRA, the key word there to me is self, because it allows all of us, as Jay touched on, to really take back the control. And maybe we'll make decisions that are right or wrong, but they'll be our decisions. And Jay and I were talking offline before we hopped on here, and he brought up a point to me. You said, Jay, that you think a lot of this people are still attracted to the stock market sometimes because of those the highs and lows, and you can still hit it big if you get a Google and all that. And then I thought to myself, well, that's true, but if I've got my money in a traditional IRA, even if the next Google comes along and I want to get invested in that, I can't do that because I don't control my money. So I love the level of flexibility to adjust to the markets that these provide. And Jay, I'd love it if you can now get into kind of the nuts and bolts of what a self-directed IRA is, because like you said, I mean, when people hear it for the first time, I know I found out about these in 2008 out in California, and I think they were more common on the West Coast. My head exploded as well. There's still a lot of people that I think that still don't even know what this is. So maybe take us to brass tacks and what is a self-directed IRA and what really are the benefits?
Okay, great. Sure, Steph, I'd be happy to. The main foundation of a self-directed IRA are really three words. They're really freedom, control, and choice. Those are the three things that everyone is going to get out of their own IRA. What self-directed means that you're taking control of the investments, just like you just touched on here, Stephan. You said that, you know, people just, even if they wanted to do something, they couldn't because they're stuck. So here we sort of take off those chains, free you up. You're now able to make your own decisions, decide what you want to get into, whether it's a nice, stable, ready, you know, predictable income from, you know, an investment that you understand, or maybe other alternatives that you want to do. Maybe you want to, you know, buy a property yourself, or, you know, manage it, or have a property manager manage it for you, but you own it. You know, maybe there are other things, there, you know, tax liens, tax deeds, precious metals, and what have you. But you could even do stocks and bonds if you really want to. But the self-directed IRA is the most powerful tool for any investor because it simply opens up the ability to do all kinds of investing. So a self-directed IRA, it's just by definition, you know, we're just saying it's something that you have complete control over. The word self-directed means you're directing it. You're the one in charge. I sometimes describe it as like, you know, you're directing your own movie. You're the director. You take the actors and you put them where you want, and you make the scenes how you want. You're in charge. You're the director. So, you know, we have two types of ways to do that. There is a self-directed IRA custodian who can now help you facilitate that desire of yours to move the money into an IRA that you control. There is a requirement that they be sort of in the background for you. They have to do some of the work. It's an IRS requirement. Let's not forget, as good as this is, it's still an IRS sanctioned tool. So that already we know there are some, you know, nothing's perfect when you're talking about the IRS. Be that as it may, you're still able to do a tremendous amount. So you'll need a custodian. That's by and large for the majority of people. You'll need a custodian. There is technically another plan where, you know, you could be, you know, a self-employed person and maybe have your own 401k. We're not going to talk about that today. But for now, just for the most part, these are what people are going to do. They're going to move the money first over to a custodian and then tell the custodian where to invest the funds. So that's, you know, generally what we can understand to be a self-directed IRA. There also is another level, and that's the LLC. We're going to get to that shortly. The main question people ask, Stephan, and you know, and this next slide tells us, you know, it really asks about, well, come on, I can't be allowed to do this. The IRS, I'm sure, doesn't want me to do this. This can't be allowed. And that's generally, you know, the first initial reaction. You know, how could it be I could actually control my investments? I'm so you're not used to doing that, you know. I've been enslaved for so long. How could I be free? So the reality is that it is actually the intention back in 1974. That was the intention of Congress. There was the idea that, yes, people, you can have your own investments. You can do it, you know, what you want to do with them. But you know, the truth was that there were no choices other than what the banks and brokerage firms could offer, and that was just the Wall Street type stuff, the stocks, the bonds, etc. You know, but technically there were some savvy, you know, maybe some very, you know, in the know elite folks with some great attorneys that, you know, worked it out, and they did it on their own. But generally, it was never heard of. There was. I'm sorry, you want to say something?
Well, I want to piggyback off what you're saying there, Jane. I want to make sure that everybody realizes this isn't some, you know, I don't even know, wacky strategy we're talking about here. This is completely within the guidelines that was created by the government, by the IRS. And just to clarify too, Jake, because I know this is, even though it seems kind of simple to you and I because we're used to talking about it all the time, I've explained it recently to family members, and then we'll talk about it for an hour and a half, and at the end of it they say, well, I don't want to take it out because I'm going to have to pay the penalty. And there is no, there is no,
very common, yeah.
Yes, I mean, there is no, you have all the same taxable benefits with your current IRA with a self-directed IRA, correct?
Yes, let's make that clear, Stephan. Absolutely. It is a rollover like any other rollover. You would be making a rollover from your old job to, let's say, one of the big ones, let's call it Fidelity. And so you make your rollover to that company, and then from there, that's not a taxable event, and then you decide you want to switch to another company, and you do that. So that's fine. You're really doing the exact same thing here. You're really rolling it over from wherever it is now into a new self-directed IRA custodian, and they will simply accept the rollover, tell the IRS that they got it, and it is not a taxable event. Yeah, one thing, a couple things would be important, Stephan, to just back up that, the legality of it was that, there was a private letter ruling back in 1982, as early as that, and so that, really started paving the way for people to understand that the IRS is accepting this. But they didn't do it without a fight. In 1996, there was a gentleman named Swanson, and, he wanted to do self-directed investing, and the IRS, I guess, got wind of it, and they said, no, you can't be doing this. And so they ended up challenging him, but they lost. And when the IRS loses, everybody wins.
Yeah.
so that's what happened. And now that just opened the door. They finally, basically, on paper, caved in 2001, and they said, okay, look, they're telling all their advisors, it's called a field service advisory. And in 2001, we just passed the anniversary of it here, 15 years later. It was April 6th. They just told all their advisors, look, leave these people alone. They're doing nothing wrong. There are some rules we've set out, and that's important to know. There are some things, prohibited transactions, things you're not allowed to do. And like we said, it's the IRS here we're talking about, so there will be some rules to follow, but there's no illegality. This is completely acceptable the way it's being done by a bona fide custodian or an acceptable facilitator. So that's just, I want to make sure that's all out there. And certainly anybody who wants those links or reading material on the legality of it, certainly there's a ton of it on our website, broadfinancial.com.
Well, and I'll tell you, I'm glad that you touched on that because it really does sound too good to be true. I mean, I think we all are kind of trained to think that money in our IRA, we can't touch it until retirement. We have no control. It's just almost like it doesn't exist. And when you know somebody that's been trained to think that, that they can really invest it however they choose. Like I said, I spent an hour and a half. I still don't think my mother-in-law gets it. Anyway, are there any limitations on what you can invest in? I mean, obviously, you mentioned precious metals, real estate. I mean, could you buy fine art, for example? Is there any limitation on what you can invest in?
Excellent. No, very good. Excellent, Stephan. Yes, there are some limitations. It is important to know there are things such that are called prohibited transactions. And prohibited transactions are really something that are initially it includes someone who is not allowed to transact along with something that is not allowed to be bought. So let's describe exactly what that means. So if you have a person who is, they call it a disqualified person, but I'm just going to say someone who's not allowed to participate in and benefit directly. Some call it self-dealing. Any kind of person, like for instance, the participant themselves, a spouse, a child, a parent, grandchild, grandparent, up and down that lineal bar there, that going up either up or down. So that is those are people that cannot be involved in the investment. When you talk about prohibited transactions, yeah, there are certain things that they cannot do. So, for instance, you cannot have someone buy a collectible, like you just mentioned, some kind of fine art. Collectibles are unacceptable. Or like we talked about, making some kind of investment in or with the people that we talked about, those disqualified persons. So even if you were going to make a real estate investment, but you're buying a house so your son and daughter-in-law can go live there, that's a prohibited transaction. So things like that are not allowed. Making a loan, to your a child or to a parent, also not allowed. Those kinds of things are prohibited, yeah.
Okay, great. Well, so that leaves us still a lot of wiggle room. And you can, this is something, even though obviously the main focus today is real estate, and obviously nobody's obsessed with real estate more than me, but I've just been curious, you can own physical gold and silver, correct?
Yeah, there are varying opinions on this. We have sourced attorneys that have said that American Eagles are able to be held onto. That is, that's, let me backtrack for a second. There are precious metals you can buy and hold in an IRA with a custodian. Okay. So with that, let's just start that over. So in terms of that, that's a great question. The number one thing that people want to know is what's allowed. So there's a list the IRS has provided. The American Eagles was really the first on that list, and then the second came other coins like Canadian maple leaf, etc., and then bullion bars. If you're holding it in a custodian, in an IRA custodian, then that will need to be held in a depository. But yes, you can buy precious metals in that. Sure.
Good deal. Well, talk to me, if you can, a little bit, Jay. I'm going to pull up the next slide here.
Sure.
And you touched on it a little bit already, but I know that in talking with you offline, there's a big difference between the LLC structure and when you're going this route with the self-directed IRA. So maybe talk to me a little bit about the different opportunities that creates when you use the...
Oh, sure. Absolutely. So that basically is the next level, Stephan. When people get into a self-directed IRA, for the most part, maybe they're just thinking, well, I have to deal with a custodian now. That's all I can do. That's all I'm allowed to do. Well, actually, that's not true. You're also allowed to, if you want to be, the manager of the funds in a bank account that you control. And again, the question is, are you sure? Am I allowed to do that? Well, absolutely you are. There's no problem with that. You're simply performing an administrative function. You're not getting any direct benefit. Again, there's no self-dealing here. The main thing is that this structure has to be done, absolutely must be done, according to IRS regulation. You need ERISA attorneys. This is essential, and it's crucial because there are many people I've talked to, and they learn about it, they hear about it maybe on a webinar like this, and they say, well, yeah, okay, great, that's easy enough. I go to a website and go buy myself an LLC, and I'm ready. And unfortunately, that can really, it can really cause a lot of problems if people continue down that road because it's not set up properly. And if it was ever, if it ever, came to the IRS's attention that that's what they were doing, and then they happened to audit it, they happened to see it, this is what they did. They said, no, you didn't set this up correctly. You're self-dealing here. So really, that's where the professionals, kind of like, don't do this at home. The professionals like Broad Financial and Madison Trust, they're companies that can help you do this correctly, keep within IRS guidelines, and continue to help you with customer service anytime you need it to assist you. So the LLC structure, what's that? So that is an IRA that invests in an LLC. It becomes the sole member of that LLC. It owns the whole thing. So again, John Smith IRA now owns the 123 LLC, so we'll call it that. And what happens is now, the LLC now needs a manager. It has a member, it has an owner, but who's the manager? Who's that going to be? Could be anybody. Could be their attorney, could be their accountant, Stephan, could be you. But 99.9% of the time, the people themselves want to manage their own funds, and certainly that's no problem, as long as, again, there's no self-dealing. They're not getting a commission or a piece of the profit. You know, they're not pocketing things out of that profit that's coming into the LLC. So now the person has an LLC. They open a bank account. They get legal documentation. They open a bank account in their local bank, and the funds get transferred first to the new IRA, then into the new LLC bank account. And now the client goes ahead and can write a check. Some people call this the checkbook IRA. And you can go ahead and write a check or send a wire, or however you send the money, and go buy your investment. Go make a loan. Go buy a property. Go, whatever you're going to do, that is available to you to go ahead and do that yourself. So that is the next level. It's a little more robust. It will cost more than just a regular IRA with a custodian. However, there is a cost savings, and that could be if the client is going to be doing multiple transactions. They're very busy. They want to do a lot of stuff. They've got a lot of interests. They want to do many things all at once. So those types of people would be better served with an LLC that they can capitalize on and utilize, themselves.
Well, and Jay, I've got a dumb question for you here. But, the methods you're talking about, and again, I've been such a big fan of these, but I don't claim to be an expert, so I could be wrong about this. But when we first started using our self-directed IRA, we set up the LLC in my family. As I recall, the first thing we did is we bought a few investment properties in Vallejo, California. And then I was advised by the people we were working with at that time, this has been a while, that the rental proceeds coming in, I could then, and basically it's like the LLC becomes its own person. It's its own entity. That's your IRA now, and it's separate from you. But I could receive the rental proceeds, and I'd have to pay taxes on those, but I could actually receive the monthly cash flow from my property. Is that accurate, or am I?
Oh, okay. Excellent. No, very good question, Stephan. This is the goal of a lot of folks, to have a steady stream of income that's coming off of their investments that they can utilize. Not to say that you cannot do that. You absolutely can. But there's a specific way it has to be done. Again, we're talking about the IRS here. We've got to follow the rules. So we'll help the clients follow the rules in terms of just the procedure, the structure, how you do it. Okay. So step one, you invest from your LLC. Step two, you get money coming back. Step three, you want to take it out. Okay, no problem. But that has to go back to the IRA custodian. And the IRA custodian is kind of the gatekeeper here. They're going to tell the IRS, okay, Mr. Smith wants to take out some of his money as income. We're going to send it to him. Here's the amount we sent. And then they report that they sent, let's say, $5,000 or whatever it is. And so that money comes back to the participant in the form of a check to him personally. The IRS is notified that Mr. Smith received $5,000. They're going to wait to see that come on his tax return. He's going to add it to his tax return as income for that year. And then, that's all fine. It's just going to be taxed at regular income tax rates for himself. However, it's very important to note that not everyone can just take income at any time without some cost. Meaning, there are these funny ages that came up and always puzzle me why they are what they are where they are. But they're 59 and a half for when a person can take income without a 10% penalty. He can just take it and be done and not pay a 10% penalty. But if someone is younger than 59 and a half, they're going to not just pay the income tax on that money, but they're also going to pay the 10% penalty the IRS imposed on people like that, as to encourage savings. The nice way to say it that way. Again, it's an age they came up with. We just have to.
It's the only time when my wife always celebrates her half birthday, so I guess that interesting to celebrate her half birthday. Well, so
exactly, yeah, and so that's just the time when we're talking about when somebody wants to take out income, that's fine. And then again, that other half age that we laugh at, it's called 70 and a half. Again, why 70 and a half? I don't know. That's what they came up with. So 70 and a half, that's when someone has to start taking out money. So at 70 and a half, they have to start taking out some money, and whatever that formula is that comes out, again, through the custodian, and they'll work with the client to figure out exactly how much they have to take out. Usually it's about, in the beginning, it's about 3-4%, something like that. Yeah.
Well, and then obviously in the analogy that I'm using, if you had a rental property, you could always, of course, put the money back in your IRA every month, or keep it in your IRA rather, and then you're not taxed on that at all until later when you decide to take a disbursement.
Perfect. Exactly, Stephan. It's exactly right. So what happens is, most people, they like to let it ride, so to speak. The money goes right back in, and then they can, reinvest it later. No taxes due.
That's great. Well, and guys, that's what I love about this, and you can see the slide we've got up on the screen here. I mean, as investors, obviously, what are we all looking for? I mean, we're all looking for effectively the same thing. We obviously want the highest return on investment that we can possibly get. And more importantly than that, we want to protect our investment capital, not just so that we have the money there when we need it, but so that when good opportunities come along, we want to have as much principal as possible to be able to maximize, again, our return on investment on those opportunities. And we want to be liquid because we want to be able to have cash on hand for when life situations happen, or again, when great opportunities come about, or when we just have a life situation where we need to spend money to buy a home or pay for a surgery or whatever it may be. And so, I always think about, I was talking with Jay a little bit offline, my father-in-law, lifelong insulator, never made a lot of money in any one given year, but he saved extremely diligently, and over the course of, several decades, he had about $400,000 in his retirement account. And in 2008, when the market crashed, that was literally cut in half in a week, and he was just devastated by it. And that was about the time that my wife and I got married, and he knew I was in real estate. We set him up with a self-directed IRA and kind of took some of that control back. And luckily, the real estate market has been so hot, he's been able to recover pretty nicely, actually. But and Jay, maybe talk to me a little bit, because I know that for me, the benefits of real estate with this strategy, and honestly, I think it's just great no matter what. For the reason we touched on, I think everybody should have a diversified portfolio. But I don't think there's anything like real estate to where if I want it, like you just touched on, I can get monthly cash flow that I can live on, or I can do whatever I want to do with, while I'm still maintaining my principal, secured in a self-directed IRA with a property that I own or invested in, and I'm gaining equity there too, and I can get monthly cash flow, because I can't do that with the stock market. But I also think that the precious metals are great, and I think it's nice to have some cash ready to deploy if you see a rare opportunity in the stock market too. Although for me, it would be few and far between. But talk to me, I know you deal with this every day, so what would you say the most common assets are that you're seeing people investing with the self-directed IRA, and why do you think that is?
That's a great question, Stephan. Just like our great, the great country we live in, there's so many different ways that people are investing with the self-directed IRA, and I think it just really depends on the person's investment strategy. What's important to them? Is it security? Is it having a return? Is it understanding the investment really well and just feeling secure that they have it? Like say a first position loan, something like that. A lot of people do that. A lot of people enjoy that. They say, well, look, I'm getting a return. They're telling me how much I'm getting. I see it come in every month, and I've got the property secured. If they don't pay me, I can take it back. So nice way that a lot of people are doing that. There are many people that buy rental property and they want to manage it themselves, and they say, you know what, I'm young enough, I'm strong enough, I can handle this, and I've already got 3 rental properties that I'm doing, so why not just do the same thing in my IRA? So a lot of people are doing that. And there are other people that, the fix and flip market. You know, there are a lot of people doing that. So there's just, you know, the whole gambit. You have all kinds of different real estate plays. You have the tax lien play. That's another whole different way to do things, you know, getting into the debt of real estate. You could be a hard money lender. You know, there's many different ways people do it that way. With the, you know, on a you know, grand scale, you know, going into, you know, big companies, or just, you know, a local friend, you know, you want to loan him some money, you know, for his business. So, you know, it's just, there's so many different ways people have been benefiting with real estate. It's, you know, probably the #1 self-directed IRA investment by far, you know, since I've heard of it. So it's really, no question, that's where the money is. That's where people are making it, and that's, you know, where it will be, I'm sure, you know, for the future.
What's cool about it too, Jay, is I'm thinking, as I'm listening, as I'm thinking through, and I've participated firsthand in most of the investments that you described there, and I've lost a lot of hair because of some of them, but I can tell you, it's neat that it creates an opportunity, and like with equity build finance, like we're going to talk about in a little bit, you know, to get secured returns in the double-digit range and in the 15% range, or sometimes 17, 18%, like what equity build finance does, it's pretty incredible to be able to take your IRA money that maybe if we all look at it, and I don't want to pick on my family today, but it's just, we did this recently, and I went through with the family member, and I said, well, let's look at what you've actually averaged on your return over the last 10 years. And it was, you know where I'm going with this, it was like 2.5%. And
yes.
That doesn't even keep up with inflation. So, you know, to be able to take it out of the stock market casino, as I've been calling it lately, and get a secured return with outfits like that, I mean, like you probably literally see firsthand people's lives actually changing and their lifestyles changing with the self-directed IRA. I mean, you probably really do every day, I imagine.
You're right, Stephan, and I do. It's really, I think that's the other thing that, you know, the dramatic change that you're talking about. When I see somebody come to us, and the pain is real. I mean, the pain is not just, you know, I'm making this much, I want to make more. It's like, I lost money. Yeah. I lost this much, and like you said about your family, you know, and I don't know what I'm going to do now, and it's very hard, but I know this is the way to go, because I want to, you know, stop the bleeding. I want to take control of my funds and get into something that I understand. You know, myself, just like you, I did a little bit of research, and I found some interesting things. And the proof is really, I mean, it's not just a few people. You think, oh, well, that person didn't make money, but everybody else is. No, that's not the case at all. Like, if you just go back, I did this in, I think it was February. I just did a 10-year back, you know, look back, and I said, well, what was the average anyway for 10 years? For the last 10 years of my life, from February back to February 06, February 16 back to February 06. The S&P, just the S&P, it was 1910 on February 4th and 2016, and then go back 10 years, it was 1280. So if you split that, okay, you split that into 10, and you see what the average was. What was the change? It was 4.76% average change. Wow. That's it. That's all they made, 4% a year. I mean, that I think that barely keeps up with inflation. So it's like, it's been the biggest sham, and I feel terrible. That's for people that didn't lose money. That's for people that just, I mean, that's just like a CD should be, but the CDs, you know, today are like 1%, 2% if you're lucky, 3, 4. So it's really unfortunate. I think that what's gratifying, as I mentioned in the beginning, is that I've helped so many people overcome that mentality that, well, this is all I can do. There's nothing else. I have to suffer through this. And like my financial advisor might have been telling me, again, nothing against financial advisors. There are a lot of good ones out there, but there are some that said, well, just hang in there, and everything will be okay. And I said, well, what do you mean? How do you know? And I said, well, it's always been that way. Well, maybe not. And so I think people have heard enough, and they've hurt enough. They've had enough, and they just said, you know, that's it. So I think when, for the most part, it's been a tough ride for a lot of folks, but I've heard it's just great stories. People have really been prospering. Clients call me back after a year, 2 years, 3 years, and they say, Jay, I had a question about this, is this and that, or something, just a small, just a detail they want to go over, and we give them the answer, and I just, just by the way, I say, hey, how's it going? I say, oh, you have no idea. I bought this, I bought that, I'm making this, I'm making that, I doubled my whatever. People, they start spouting off about all the success they've had, and certainly not everyone is, guaranteed success with this, but once they know what they want to do, they have their eyes set on something, and they go and get it, they're motivated, and there's just no stopping these people. I would love to have, if I could, the thousands of people that signed up here all in one room, and just give just have everybody tell their story, because it's, by and large, it's just all been positive. So
we need to retreat, Jay. I think that's what we need to do.
There you go.
Well, and think about, gosh, that's crazy. 4 point. I'm still blown away. Because think about the roller coaster ride that people had to go through the last 10 years to average 4% too. That's the other. Yeah. How much heartburn and hair loss and all that. I'm getting balder every day just being in the.
I say this joke. I say, stocks go up, stocks go down. But the one stock you might want to consider is investing in the manufacturer of Tums. So there you go.
I know that's for me. Well,
Pepto-Bismol, whatever.
Yeah. Well, and the thing that's cool too, I love hearing those stories, because at least with a self-directed IRA, at least you give yourself, obviously nobody knows if you're going to go out and double your money, but it does happen, and at least you've got the opportunity to do that. If you're in the system, I'll call it, these mutual funds, you don't even have an opportunity to double your money. That's not even feasible. You couldn't even make 30-40%. It's never going to happen. It's literally not possible. It's structured to not be possible. So it gives you at least the chance for greatness, and it also gives the chance for supreme stability, because, heck, if you're going to average 4.5% over a decade and have to sweat it out to get there, you could put that into an annuity. You could put that into something like equity bill that's going to get you 12% or 15% guaranteed over the same. So anyway, I don't want to get too.
Yeah, no, you're absolutely right. I would just, be great if more people knew, and I'm happy, we're doing this, because again, happy to teach and get people educated to know that they have this option.
Well, and along those lines, Jay, let me ask you. You can see I've got the company slide up on the screen for Madison Trust, and I love it if you could tell everybody that's with us kind of what your values are, what your mission statement is, and what a conversation with you guys would be like.
Sure, absolutely. So just to be clear, I am on. There are two companies here. There's Broad Financial, and there's Madison Trust. Broad Financial, we started. We're looking at over 6 years ago, and we did it primarily to help the self-directed investor get into an LLC model or a solo 401k, basically a checkbook control model that they can utilize. And we realized after a short while, after using a third-party custodian to help our clients, that we, based on our core values, what we believe in, what we do here, we just do things a little differently, probably than most. We care a great deal, and I think that shows in everything we do. It's just, when we knew that our custodian we're dependent on them to take care of our clients the way we want them to be taken care of. It's like any subcontractor. Imagine, you cannot replace your own care and time and attention that you would give to your client. So we just knew that the writing was on the wall. We need to get our own custodian. We need to set up our own company. And that's what we did. It took you can imagine, a long time. There was a tremendous amount of regulation. There's a lot in that to get it up and running. But once we did, we got the we got the company going, and then developing a core set of values was key to the company starting out. Like any foundation, you've got to have a strong foundation, otherwise your building will not stand for long. So our foundation was built on working together as a team, that we communicate, we take ownership, we respond quickly to our clients' needs, we're positive, we show respect, we appreciate what others do, and we're proactive. And just, I'm not just stating these words, I've seen this on a day-to-day basis. I go in and I'm looking for something, and I say, where's this paper? I'm looking for this paper. 3 people jump up. Everyone's talking. Where's the paper? Jen needs the paper. Let's go. Let's get the, And then, well, how can we make a new one? And everyone's thinking of ideas. And it's just, it's a beauty. It's really a beauty to see a team work together like that. And that's how our clients are treated. We're all, wanting them to succeed. And so it's, we're really excited, and I think when people choose us, and there are some choices, we won't deny that. There certainly are choices out there, but when they choose Madison Trust or Broad Financial, that means a lot to us, and we take that, with, humbly, and we know that's, that client, is trusting us with getting it right and freeing up their money and giving them the kind of help that they need. So you're basically going to have the Madison Trust experience will be, a custodian who, has a little more IRS paperwork than we do. They've got some regulations to follow, and they've got some laws, and they're audited every 18 months. And you can imagine the regulation that goes on with any kind of financial industry company like that. But even with that, we've minimized the paperwork. We've made it as easy as possible for our clients to get going. And the customer experience is for our clients, is an enjoyable experience. We streamlined it to make that a priority, to make it enjoyable. And then, if the client chooses they want to come over to Broad, then we would love to have them as well. Broad Financial offers, like we mentioned, the checkbook control plans, the LLCs, the solo 401ks. But if you simply need Madison, it's fine. We're happy. Whatever you need, whatever's best for you, that's what's good for us. So when you call, you'll call me. I personally would like to assist everyone. If it's humanly possible, it depends on how many people call, but I would personally like to assist everyone who calls. So I'm putting up the Broad Financial number there. It's 800-395-5200. So when the phone call comes, they answer, you'll get a live person during business hours, and even after business hours, we have a live person answering the phone. It'll be routed to me. Just ask for Jay. That's really, I'll ask you, just ask for Jay. I want to personally greet you. Thank you for listening to this, webinar introducing us, and I want to help you. So whatever you need, Broad Financial or Madison Trust will be there to assist.
That's awesome, Jay. Guys, I got to tell you how rare that is. We've done about 120, 130 of these webinars now, and it is very rare. And this is one thing I really loved about Jay and talking with him last week. And he says to me, Stephan, I'm just so excited to educate people on this. I'm so excited to let more people know this. And I know, Jay, you really feel like that's your greatest service, is by just that education. And that was so in line with us. I knew that you guys were the right company for us to highlight. And I can tell you, we've been pretty diligent. We've been a fan, but we've never recommended someone to IRA custodian until now. And I couldn't be more thankful to you guys, to you personally, that you're doing this, because I know you made a point. You said, I really want to talk to everybody one-on-one, which hopefully we make you regret that, a bunch of people calling in. But that is very nice of you to take that extra time and really be able to personalize it, because everybody's situation is different. So thank you for that.
No, my pleasure. And, it's some people, hearing these accolades, and I appreciate it. I'm really asking you for it, Stephan, but I appreciate you giving them. The accolades are nice, but, the proof is in the pudding. And we have an A+ rating with the BBB. That's been since we started, since we've been rated, and we've kept that A+ rating. It's very, very important to us. every client is important and is treated as such, and that's both on the Madison side and the Broad side. So we're very, just, we're all into the customer service experience and making sure that it goes well, and that you can be basically free to go ahead and invest the way you want to invest.
That's awesome, guys. Well, as we always talk about, guys, there's a ton of value in knowledge. There's only so much we can cover in a webinar, even though I hope you enjoyed this portion of it. We're going to get into the live portion in just a moment, but I highly recommend you take advantage of this guy's time. Jay is a expert on this topic, and I think it's a topic that can really change the lives of everybody on this call. So I personally want to give you that number again and invite everybody to take advantage of Jay's time as much as we can and get it personalized for you. And if nothing else, you'll be able to take that knowledge base moving forward and utilize it to hopefully better your investment future. So that number again, guys, is 1-800-395-5200, and just ask for Jay, and let's make him regret calls with nice. Anyway, well, Jay, we're going to get into the live Q&A now.
Okay, great. I'm very excited to help out with anybody's questions. Yep.
Well, we'll make sure we'll hopefully get 100% of the questions answered for you guys. Just type those in the chat box. And again, Jay, I really thank you so much for taking the time.
My pleasure, Stephan. Thank you. It's been an honor.
Okay, guys, thank you. We are back live. This is Stephan here, and I do have Jay with me live. We've had some awesome questions come in during the recorded portion already, so I've got about 10 to 15 solid questions here we're going to bug Jay with in a moment. Before we get into the Q&A, I just wanted to talk with you guys a little bit on the real estate side of things, because you could hear on the recording, which I hope you enjoyed and I hope you benefited from that knowledge there from Jay, how giddy I am about IRAs, but obviously my background is in real estate. And so I wanted to talk with you guys. You might be thinking to yourself, obviously the control and the ability to be able to invest in whatever we want with the IRA as a self-directed IRA, that's the biggest benefit. But you might be thinking that you have to choose between some of the roller coaster ride, high risk, high reward type investments like oil futures or even precious metals to some extent, even though it's an inflation hedge. I mean, there's obviously been a lot of fluctuation there the last few years. And some parts of real estate investing in general, which we all know that even though real estate is a fantastic investment asset class, there's also a lot of risk hassle when you go about it on your own. So I wanted to make sure that you all realized out there with the equity build finance model what that entails and why I personally believe it's the strongest investment opportunity that fits best with a self-directed IRA. And that's because with equity build finance, and forgive me, those of you that have been on some of our other webinars already know this and know how it works. For those of you that don't, when you're investing with equity build finance, you're investing in private mortgage notes. So effectively what you're doing is you are becoming the bank. You're becoming the lender. And you're investing in notes in these properties that are completely managed by Equity Build, the sister company to Equity Build Finance. And you're generating fixed returns, usually on a 12 to 24 month period with the note. Now those returns start, as you can see on the slide I'm going to show you here, start at 11%, can go as high as 16%. Actually, we just had an opportunity recently where it was as high as 17.5%. And the reason why that's insane, guys, is not just because 17.5 or 16% or 15% are extraordinarily high returns. It's because of the stability involved in this. And it's not the focus of today, so I don't have time to fully go through why the returns are so secure with equity build finance as a model, but I can tell you on nearly 1,000 deals, 1,000 transactions, their payment track record has been literally perfect. So over the last 10 years, when we've seen the widest market shifts, perhaps in history, certainly in my lifetime, and I'm in my mid-30s, that we have ever seen, where equity build started initially in 2005, Equitable Finance came about in 2009 when they pivoted after the market crash, and the two companies began to work together to create this amazing ecosystem. They have been perfect. And so when we look at the stats that Jay threw out on the recorded portion of the webinar, where the S&P has averaged 4.7% over the last 10 years, and then we look at what Equity Build Finance has been able to do, generating returns in the double digits, 11 to 16, 17, even 18% on occasion, it's really astonishing. And that's where it gets into the point where it is lifestyle changing. I don't want to use the term life changing too loosely, but it's certainly lifestyle changing, guys, because if you do the math on that, think about if you're, like a lot of us, and you've worked diligently to save up, maybe you've got a few $100,000 in your retirement account that's just sitting there. It's at risk. It's being controlled by people that are not you, that are not us, that think they know better than us. And quite frankly, their track record is pretty poor, because over time, it's been proven that that the returns just don't match up. But if you don't want to go out and become a real estate investor overnight, you don't want to take the time to learn that industry from scratch, or if you just want to focus on whatever it is in your core business is making you money, there is an opportunity to get those same high returns and have that stability. And think about that extra 10, 11, 12, 13% every year over the last 10 years, and what that would do if you had started with, say, $200,000 in your IRA in 2006. Compare where you'd be at today with the Equity Build Finance model and where you'd be at with the S&P 500, and you literally, you'd be living in a completely different house for your retirement. You'd have completely different flexibility with your time and your travel schedule, and depending on what's important to you, you might be driving a different car, you might be traveling more, whatever it may be. It will change the caliber of your life, and that's why it's so important to me to highlight not only the strategy, and quite frankly, guys, I don't care where you invest in. Anything you invest in that you make the decision, to me, is going to be better than just leaving it up to the banks and to the hedge fund managers and all that nonsense, because it really comes down to one simple fundamental question. Who do you trust more with your future? Yourself or the hedge fund managers, mutual fund guys on Wall Street that have never met you, don't care about you? And we saw in 2008 what happens when they make the wrong mistakes. We all get penalized for it. So I hope everybody on the webinar answered that you have more faith in yourself. If you didn't, then you and I need to talk, quite frankly. But and I can kind of walk you through some things, and we'll get you up to be where it needs to be. But if you are going to take that journey and you're going to take control of your financial future, Equity Build Finance is certainly an amazing option. And quite frankly, I don't say it just to say it. It is the best option specifically for retirement planning that I'm aware of, because I've never found any investment vehicle that has that rare combination of extremely high returns and extreme stability. Everything they do is about stability. So I don't have time to get into the details more than that. So I invite all of you as well that are on this call to call in and discuss the opportunities that are available on the Equity Build Finance side, understand why their model has been perfect on the last 1,000 transactions, and maybe you can work something out. If you do have a self-directed IRA already, this is an amazing vehicle for you to earn higher returns and be more stable. And if you're looking into the self-directed IRAs for the first time, obviously that's a great option looking as well. So you can see that number on the screen, 877-978-1869, 877-978-1869. You can also email invest@equitybuildfinance.com. And I hope you take advantage of that, because just like Jay and myself, they really care about education as well. And it's really a two-part puzzle, guys, to where we can really hopefully all collectively use our strengths and our knowledges that we have to be the most successful investors that we can possibly be. Without further ado, I am going to get into the live Q&A portion here with Jay. And Jay, are you with me?
Yes. Hi, you hear me okay there, Stephan?
I do, and thank you for coming back with us, Jay. And I got to tell you, I really, everybody, we were getting amazing feedback during the recorded portion. So thank you again for taking the time and educating all of us on this topic.
My pleasure.
Good deal. Well, we've got some great topics and questions that are coming in here, Jay. But before I get into the real specific ones, you had a lot of people ask a similar question.
Okay.
So I'm going to kind of turn that into a hybrid, which is effectively, if I want to start a self-directed IRA, what are the steps? What is that process? Take me down to kind of brass tacks. How do I go about actually doing that in the most simplest form?
Okay, absolutely. So basically it's a pretty straightforward, simple process. You would get a new account set up. You'd set that up with the new IRA custodian. Again, if you choose Madison, great. We'll give you very simple forms to fill out, and you fill those out and you mail them back. The custodian receives them. They set up a new account. Now the money that you're going to move into it will come from somewhere. So that could be an old 401k from an old job, an old 403b, or it could be an old IRA that's been sitting. So whatever that is, traditional, Roth, whatever you have, that will simply be rolled over into the new self-directed IRA account. The custodian will have a transfer form. They'll communicate with your previous provider, whoever that is, Fidelity, Schwab, TD Ameritrade, and they will have your instructions to move the funds over from that previous account into the new account that's in your name. And if it's an old 401k or 403b, you will get a rollover form from that company, wherever you used to work, and fill that out and tell them about the new account that you have, and then you would effectively be making the transfer. You'll tell them to send the funds either to Madison, or what they sometimes do is they'll send you the check and then you'll forward it on to Madison. So now we have the funds moved over, we have the account set up. Now it's time to basically wait for the funds to clear. Depends on how they're sent. I usually recommend folks, if they can, get it wired. It just saves a lot of time, but certainly it's up to you. However people want to roll them over, that's fine. But there is time for the bank to clear the funds and time for the check to come, and that could be upwards of 10 days to 2 weeks for all that. So a wire, though, usually takes place within a day or two. So certainly a time savings if you wanted to opt for that. Meanwhile, so the funds are in the account, and now it's simply waiting for the instructions. There are investment instructions that you will simply tell the IRA custodian. You'll tell Madison, okay, please send my funds to this investment. Let's say it's equity build. So we'll have instructions on how to send it and what account it should go into, and we'll have some paperwork on the investment itself, and that's it. Once the investment's made, now the arrangement, whatever that is, let's say it's a monthly payment that comes back to the client's IRA. So if that's the case, then the client will receive that monthly payment in the IRA account, and they'll be able to see that themselves come in, either by checking in with Madison or with their online access. So and once the money builds up again, they could certainly go ahead and do other investments as they wish. Can certainly roll in other monies too if you want to start out with a certain amount and then add more later. So there's basically that's the cycle of how a self-directed IRA would work.
That's fantastic, Jay. And you made me think too. I wanted to point out too one last thing on the equity bill finance side that is, I think, key here to note is those payments are made monthly, and so I think that's why it's been such an effective investment strategy for people using a self-directed IRA is you can watch your account grow every month, and then obviously if you're earning 15% on $500,000, you're making $75K a year on that while maintaining the principal. So over time you get that up to $1 million. The higher the principal gets, then the higher your earnings, and you can really watch that multiply quickly. I have a unique question here, Jay, that I want to start out with. Kind of a tough one here, I think, for you. But
okay.
This is from William, and William said, can you couple one or more individual IRA holders together or with the same IRA account in an LLC to do a single transaction?
Okay, excellent question. Actually common, believe it or not, Stephan. Many people want to do that. When someone calls and asks, to look into a checkbook control plan, one of the first questions I ask them is to say, do you want, is it just your funds or is it also a spouse's? And we can get into that. There are a few different strategies how to put those funds together. So William, the short answer is yes.
Okay.
The long answer though would be it really depends. There are a few different ways to do it. One way we could do it would be at the custodial level. You could just have two IRAs investing, side by side into an investment. It could be a little cumbersome. There's a long title there on the on whatever contract you're getting into, so could be a little cumbersome to deal with it that way, although could be that's enough. The next method might be to set up a new LLC that both IRAs invest into, and once you have both of them in there, now you effectively have one account. You have one bank account the LLC will operate out of, and you'll write your check or make your investment however you do it simply out of that LLC. The LLC will be the investment owner, the one who makes the investment with the two IRAs in it. And then the third method, and this is again possibly for some of the people listening, I don't know, William, we'd have to see about your situation. Anybody who has self-employment income, a third method, very effective, very nice. I often recommend it if it fits. It's a solo 401k. Broad Financial does that as well. Two IRAs now effectively become part of one 401k. The funds are put together inside of a trust. You set up a trust bank account, and now the trust will be the owner of that asset, making the investments, etc. Nice way to consolidate.
I got to tell you, you surprised me with that one, Jay. I actually thought you were going to say no, and so I was thinking about explaining different ways to do it, like separately in the same property. But that's pretty neat that you can actually do that. That's great.
Mm-hmm, sure. Yeah, no problem.
Another question here from Renee, and she says, what books or periodicals or websites can I read about investments that can legally be made with a self-directed IRA and still have all the tax benefits? And I think you told me you guys actually provide a list when they sign up with Madison Trust. Is that right?
Well, you know what it is, Stephan? Technically, we can't offer what's called financial advice. So if just to be clear on the question, I want to help Renee. But just if she's asking for specific investments, that's more of a outside of our realm. But I will tell you, yes, there are a lot of educational materials on our website. You can learn a tremendous amount. You can invest in all kinds of things. For instance, real estate, making loans, tax liens, precious metals. The whole gambit. It's all there. There are some prohibited things to not do. Okay, those are things you cannot invest in. Those would be collectibles. Like collectible art, baseball cards, things like that. And certainly there are prohibited transactions when it involves specific people, you, a spouse, a child, a parent, up and down that lineal line. So it's up to, more or less, it's up to you to find the investments, but a Broad Financial and Madison Trust will definitely help you and guide you into what you can and cannot do. And as I mentioned, a ton of that information is on our website. Certainly, you can take a look at broadfinancial.com or madisontrust.com.
That's great. And kind of along those lines, I've got a good question here from Larry that actually a couple of people have asked as well, which is how much does it actually cost to set up a self-directed IRA?
Okay, excellent question. So when you set up a self-directed IRA, you've got, like anything else, a few fees to get it going. The initial setup is with Madison Trust. If you're just doing a custodial account, that would be $50.
Oh, wow.
So you're setting it up, for $50. And then your investment itself, the one time you're making that investment, going out of the account, that's another $50. So we just say, just round numbers, it's $100 to set it up and make your investment. If there are other things like, for instance, incidentals like wire, overnight, expedite, there are different fees that may come in, to play. If, let's say, you do a wire in, that's $25. And if you're in a hurry to get the investment done, a wire out would also be $25. So let's just say this person maybe, it's $150, the whole thing done. Now, the ongoing maintenance is there, and there is going to be an initial setup for the first quarter that it's going to be included. Each quarter is $45 for Madison, so they're going to actually have $45 paid as well. So again, in this example, we've got 50 setup, 50 investment, 2 wire fees, and a first quarter, so we're up to $195. The first, all in, just that's the first amount of fees. Then the next quarter would just be $45. From then on in, it's just $45 a quarter.
I got to stop you, Jay, because I got severely ripped off in 2008 because I paid like $3,500. So you're kind of blowing me away here. But anyway, I'll shut up and let you continue.
I'm sorry to hear that, Stephan. Well, in terms of this, I mean, we're not obviously it's certainly we're not going to be charging for percentages. There are custodians that do that. And that's a different model. Some people are very sensitive to that, being coming from financial advisors who charge them a 1% or 2% or whatever. So in our case, we knew that would not appeal to the vast majority of people, so we do not charge that, and your base fee is very minimal, $45 a quarter. There is, just for Madison's sake, there is going to be a reserve. There will be a $500 reserve. It just sits there, and the $45 comes out of that every quarter. And it gets low after a couple of years. It goes down, and then they just, mention that you're going to have to, fill it up again and keep it going. And that's that. There really is not, in terms of, multiple fees for every little thing. We don't want to, not looking to do more than necessary.
That's great. Well, I've got a good question here that I think, being that we're a real estate oriented group here, I think it's a good question. A lot of people are wondering. So Craig said, Jay, how involved may one who owns real estate be in, let's say, for example, performing repairs, landscaping, interviewing potential rentals? Because you had mentioned that there's kind of an arm's length policy to some extent. So how active can a real estate investor who's using a self-directed IRA be?
Excellent question. And this is really key, because this is, where the rubber hits the road, as they say. When somebody's really into it and they want to do as much as possible, that's the whole point of this. And yet, like anything else the IRS does, it's not perfect, and we have rules, and there are things we have to watch. So here's where Broad Financial and Madison Trust will guide you. And this is part of our service. Anytime you need help with something, you're not expected to know all this stuff, at any given moment. You give us a call. But Craig, here's your answer. Our attorneys have looked into this, and the IRS code is pretty clear. There are things that you can do and cannot do. What you cannot do, I'll just start with that, because that's usually what the IRS code talks about. What you cannot do is any kind of self-dealing, self-benefit, anything like that. And the IRS determines when, let's say, you buy rental property, okay, and you want to fix it up, and you're handy, and you could do it. Unfortunately, that would not be allowed, because that would be what's called an excessive contribution. It's a kind of a roundabout way to get there, but basically it's saying that, hey, yes, you could fix it up, but you could certainly put in $50,000 worth of work if you wanted to as a handyman, and that's essentially just giving that money to your IRA. So they say, no, you can't do that. So okay, so fine, no physical work on the property, and it really is extreme. It means no physical work, even the smallest thing you'd think of, but they have to draw the line somewhere. But on the other hand, our attorneys were asked, and we said, what about administrative work? What about hiring contractors, interviewing tenants, checking on the property, doing whatever admin you need to do to protect your investment and to maintain it from a pen and paper standpoint? There is no limit. That's fine. You can do all that, and it will not be a prohibited transaction. You're allowed to do all of that. It's simply something, as an unpaid manager, you're just maintaining the books, so to speak. So in that sense, that you are allowed to do. There are some nuances we can get into, but basically those are the major ones. that people should know. When it comes to real estate, if you're going to manage the property, yes, you can do admin work, but you cannot do the physical work.
Wow, great question, Craig, and good stuff, Jay.
Sure.
I've got a question here. This one's kind of more of a comment than a question. I did want to address from William, who said the rule of 72 is a benchmark. You can actually, calculate how long it takes to double. I think what William was referring to, which I actually, when I heard the playback myself, I wanted to just clarify. On the recorded portion, you heard me say a couple of times that mutual funds, you will never be able to double your investment. I should clarify what I mean by that is in a single year is what I'm talking about. So when I talk about you'll never get 30, 40%, I'm talking about an annual return. Obviously, if you got 1% a year, you could eventually, in 72 years, you could double your money. But when we compare 4% to 15, 16, 17%, obviously going to happen a lot faster. And then really what I was touching on there too is just to have the ability to be able to possibly double your money in a year, like you mentioned on the call, Jay. And so let me just add, we've had a couple people kind of along those lines ask this as well. Is there a maximum return that you can get? I actually had a gentleman email me last night. I promised him I would ask this question. He said he's considering doing a loan where he would get 32% on a high-risk loan. Is there a limit to the percentage return that you can make when using a self-directed IRA?
Awesome, great question, and it's also common. I find it interesting that we're living in an environment where maybe this is off the topic a little bit, but it's that success and achievement and all these things are questionable, but I will say just on that topic, absolutely you can make as much money as you're able to, and there's no limit to that return. Because ultimately, what's the IRS doing? They're saying, look, you can run the table, do what you need to do. Ultimately, we're going to get paid because when you take the money out at one point, they're going to, you're going to pay taxes on the income taxes on the money when it comes out. While it's in there, believe me, whatever investments you could do, and they are approved, by the IRS, there's no problem with them. Absolutely, go for it. Make as much as you can.
That's great, guys. And again, to me, that might be the biggest benefit of this whole discussion we're having right here is that at least give yourself that chance. Obviously, I'm not saying everybody's going to go out. Nobody's saying you're going to go out and you're, of course, going to double your money or triple your money. But, it's possible, and at least it gives us the chance to bet on ourselves, our own judgment, adjust to what we see in the market and opportunities. Jay mentioned Google on the webinar. If you saw Google at $80 a share when it was coming out and you decide you want to put all your money in that and it goes to 500, then good for you. You just quadrupled your money. If you buy a property in 2009 with your self-directed IRA, today you probably tripled your money depending on where you bought it. Or if you want to have a steady, stable return like with equity bill finance and get 15, 16%, you can make that choice as well. So, yeah, just love those opportunities as opposed to giving it to Bernie Madoff. So anyway, okay, so let's see. We got a bunch of good ones here. Let's see. Okay, Donna asked, this is interesting. Donna said, can you roll over an investment that you bought with a 1031 exchange into a self-directed IRA? And I'm going to piggyback on that question and say, because we had a lot of people ask, are there max contributions that you can make to your self-directed IRA?
That's a great question, Donna, and it's important to realize with this that really there are two sides to the investment world, and sometimes it's confusing and sometimes it's hard to know which side I'm on. But really, for most people, it's on the personal side. Things work a certain way. There are strategies and tax advantages, tax strategies that people implement in order to help themselves. And that's great. In the IRA world, those kinds of tax strategies are not really in play. So let's just say that for just for clarity here, just to answer the question, and Donna, I definitely want to help if she wants to go over this more offline. I'd be happy to. But in terms of this, an investment that had 1031 exchange, that says to me right there that was a personal investment, that you bought a property, it grew in value, and you didn't want to pay the taxes, so you did a 1031 exchange, you bought another building with it, and you're just extending out that that tax. So that's on your personal side. So technically, it's really not involving the IRA at this point. So on that end, I think it's really talking about the personal end, not the IRA. However, Stephan, you asked me, is there a maximum contribution somebody can make? And that, unfortunately, yeah, there is an answer to that. Yeah, the IRS has certain maximum contributions, new money coming into the plan. So that would be for an IRA. It is $5,500 if somebody's under 50 years old, or if they're over 50, it's $6,500. If it's a SEP IRA, that would be somebody who's self-employed and could take a percentage of their income. So that would be $53,000 for that person. For a 401k, though, a person who's self-employed and getting a 401k, that can get interesting because it gets there quicker. If someone is under 50, it's again $53,000, but if they're over 50, it could be as high as $59,000. And so that's, that's in terms of maximum contributions of cash, new money, earned income going into an IRA or 401k.
And those are the same limits with your IRA in general, right? That's not different because it's self-directed. Okay.
Exactly right, Stephan. Yeah, those rules are across the board. Correct.
Okay. Good deal. Well, another good question here from Nettie. And Nettie said, if I am in the stock market, bonds, and cash in my traditional IRA, can I just transfer all of my IRA proceeds into a self-directed IRA and then let it sit there until the right piece of real estate or right opportunity comes along? Does it still act the same as a traditional IRA while it's waiting to be deployed?
I hear that. So Nettie, it was asking to be able to move over assets in kind, as they say. The assets in kind means stocks as they are, leave them as they are, and then just simply move them over. And then when you're ready, go for the new investments. So Nettie, yeah, you can do that to some extent. With Madison, though, they've chosen to simply be an alternative investment custodian. So they will not be holding on to stocks and bonds if you choose, to work with them. Another method could be, it's possible if you wanted to, we have, again, depending on if you're self-employed or whatnot, I just helped a client a self-employed client, move over his TD Ameritrade account intact over to his new solo 401k trust account. And that trust is also, that account is also held by TD Ameritrade. So it is possible. You can technically, yeah, you can do it. Generally, for 95% of the people, most of the time, they are going to sell whatever they have because they're interested in doing the investment, shortly or as soon as possible, and then move the money over as cash, and then turn around and invest it as cash into the new investment. That's generally how most people do it.
But if you, for example, Jay, if you had a feeling that the stock market was going to crash, and you wanted to just be in cash for like 3, 4, 5 months and just wait, then you could take everything out, put it in just cash with you guys, and then in 3, 4 months, whatever it is, then you could deploy into real estate or whatever you want to do at that point, right?
Yeah, absolutely, and that's fine. I mean, just to be, perfectly straightforward, there is no, like a money market or cash, gains while it's sitting at Madison. It really is just a neutral position. But yeah, Stephan, if someone felt that was what they wanted to do, and they're going to cash out anyway, and you wouldn't believe how many people we've talked to, they're sitting in cash now anyway, and they haven't invested it. So, never mind that they're just hearing about self-directed IRAs now and moving it. But when we talk to them and say, how's it going? So, well, I've been in cash for the last X number of months, years, whatever. And so that, certainly if somebody's in that position, you could just put it with the self-directed custodian and be ready, when you want.
That's great. Well, and kind of along those lines, this was a great question that Renee asked, and I'm going to answer this one first, and then I'll let you, if you piggyback on it, Jay. But Renee said, and just so you know, Renee, you and I are kind of, I think, thinking it the same way here. But she said, how can a self-directed IRA protect against a multi-sector crash, stocks, bonds, real estate, metals, etc.? There are rumors and predictions about a really big one coming soon. And Renee, the reason I wanted to answer that one first is because I think that again speaks to the flexibility that you have to make your own judgments with a self-directed IRA. As opposed, if you're just sitting there with a T. Rowe Price mutual fund and the market tanks like it did the first month and a half of this year, I think it was down like 10% at one point for January. Then you're there, you're done, you're down 10%. It is what it is. If you've got a self-directed IRA, if you think that, Renee, which I might think that for the stock market, and maybe you do, you can act on it, you can adjust to it, and you can then make your portfolio reflect whatever your personal views are. Where you can't do that with a traditional IRA. Would you agree with that, Jay?
Yeah, Stephan, you said it perfectly. I mean, it's really the whole point, the whole beauty, the strength, the power, the control, the freedom you get out of having a self-directed IRA is really, it's in the name. You're in charge. You're in the driver's seat. You're in control. And whatever assets you want to invest in, obviously no one can guarantee or predict the future, but at least you know that you made those decisions based on what you wanted to do, and you're not subject to the whims of Wall Street or to some one person running your life, your financial life. So that is, it's a very empowering position to be in. And whatever you choose to invest in, it basically can be a diversified portfolio. You're not required, and this is something else that kind of dovetails into it. Some people ask, well, if this is a real estate IRA, can I only buy real estate with it, or can I only get, it's because it's sometimes named as such, and people think, well, this is only for this kind of precious metals IRA or whatever it is, and the truth is, no, it's wide open. You can do any kind of legal investment that you are able to do, no matter how diversified, no matter how much you want to put in. That's all under your control, and it's really it's an unbelievable thing in this day and age that more and more people are finally getting it, and they're hearing about it, and they're excited, and they say, I'm not going back. There's no way. I'm not going back to the old ways. I'm going to start off on my own, and certainly have maybe trusted advisors, have investments that they research and they know about, but to be in the driver's seat, there's just absolutely no better position to be in.
I love it. Well, and a brief follow-up question, real quick here from Renee as well that I'll answer. She asked, are private mortgage notes, like with Equity Bill Finance, affected by the homeowners who can't pay their mortgage and the high mortgage failure rate? And Renee, the answer to that is no. And that's why it's so amazing, and why I strongly recommend, especially you personally, Renee, if you haven't already, use that number on the screen, call in and talk with them, because they have had 0 foreclosures in the history of their company on nearly 1,000 deals. And the reason for that is because Equity Build and Equity Build Finance, the two companies, work together to control the entire process. They're not lending. They don't lend money to anyone outside of their infrastructure. They don't lend to individual people. They have thousands of investors on the real estate, turnkey real estate side, which is Equity Build, that are all A-paper borrowers, prime credit, prime incomes, whole 9 yards, that are the buyers of these properties. Equity Build manage them, does the improvements, rent collection, so on and so forth. And then Equity Build Finance is the vehicle that provides the financing for those. So that's why it is literally the only high-earning investment opportunity I've ever seen that has such a win-win scenario, where they're rooting for the payments to be made and for both sides to succeed, because they're invested in both sides of the outcome. So that's why they've never had a foreclosure, even though the market went crazy and crashed in 2008. So wow. You better call Renee, or I'm going to be mad at you.
Wow, that's really impressive.
I got a good generic question here too, Jay. Is there any difference, this is from Nettie again, is there any difference between a traditional IRA or a Roth IRA when you're converting to a self-directed IRA?
Good question, Nettie. Yeah, they might think there'd be a difference in them because they do have different tax treatments. But in this case, No, you'll be able to set them up just as easily. In fact, just today, I have a client who it's an interesting connection. They invested their traditional IRA in equity build, and then they called back and they want the Roth IRA now to be invested in equity build. So it's just a funny, I mean, just asked, so I just thought you brought it up. So anyway, so the gentleman is setting up in a second account. It's the same procedure, same thing, just, same application, move over the money, turn around, tell us where to send it, etc. It's all the same.
That's great. Okay, I'm going to do two more questions and then we'll wrap it up here, guys. And Norman asked, are you able to trade Forex with a self-directed IRA?
Excellent question. Norman, we have helped out trading academies and many people who are into trading, and so Stephan, despite you and I maybe having a jaded opinion of the stock market, there are those who can really do well. Sure. And making, trading is their focus, and they want to do it, and they're good at it. Please, all power to you. Absolutely, you can do that. However, Madison Trust will not support, as again we mentioned, that they won't get involved in stocks and bonds and whatnot. There isn't a trading platform that they have. So what you do is you call Broad, and we'll set up an LLC for you, and you'll just shift the money over through Madison and then into your LLC. You'll set up that trading platform with whoever you want. That's totally up to you. You choose the provider out of your LLC. That's one way to do it. Or if you have some kind of self-employment income, then the solo 401k with the trust account would be the way you'd go. Same thing, money moves into that trust account, and then you contact that provider to set up your Forex trading.
Perfect. Okay, I've got a real quick, easy one that I think you kind of covered, but I'm just going to ask before I ask more broad. And this is from Jamie. Jamie said, can you write up the lease agreement for your rental property and have that still be okay with your self-directed IRA?
Yeah, I mean, the lease agreement is fine. You can write that up, Jamie. It's just that it needs to be according to the regulations that the custodian, if it's going to be a custodial IRA, you're going to do that through, yes, you could write it up, that's fine. It just has to be according to the regulations. There has to be certain things they're going to look for, and also making sure there's no prohibited transactions going on there. But basically, yeah, that's fine. You can write it up. There's no problem with that. However, what we generally recommend, if someone's not going to do a passive investment and they're going to be actively managing a property, then it is recommended, and this has been my experience since in the years I've been here, 9 times out of 10, you're probably going to want to have a checkbook control plan. It just means, that much more control, that much more peace of mind that, you're going to buy this property, you're going to want to, do some either cosmetic work or maybe some, major work. You're going to hire contractors. You need to pay them on time. Maybe you want to buy materials, all that, and then on top of it, getting rent payment, tax, the property tax, things like that. All that in a whole year of work through a custodian. As much as we love Madison, it's not recommended. It's really recommended that you take control, that you pay a little bit more, get the LLC up and running, get the bank account, and you run the show from there, because that just means more peace of mind for you. Long term, also some cost savings, because all those transactions we talked about would probably be costing you more based on just fees they have to charge. So ultimately, long term, you would be better off, much better off, if you're going to be the owner of a rental property, leasing it out, that you would actually call Broad and get the one of the checkbook control plans up and running.
That's awesome, Jaywan. I'm going to do the last question here from Nettie, because, Nettie gets what Nettie wants. So you kind of touched on this a little bit, but she wants you to just clarify. So do you have to start taking money out at 70 and a half years age, or can you keep growing your portfolio beyond 70 and a half years of age?
Excellent question, Nettie. And this actually does make a difference now. Going back to your previous question, Nettie, you had asked about traditional and Roth IRAs. So here's where it gets interesting. And this is where I do like the Roth in this sense. With a self-directed IRA, it's the same rules as the traditional, any IRA that you have, a traditional or Roth, all the same rules. What are those rules? So at 70 and a half, the government says if you have a traditional IRA, that means you have not paid tax on it yet, you've let it grow, tax deferred up until now, at 70 and a half, you need to start taking out what's called a required minimum distribution. And there's a calculation for that, and Madison will help you do that. They'll help you figure out how much that is based on your total portfolio. Not if this is all that you have, then whatever's in Madison. But if you have other things, it will be just part of that big picture. So you'll take a required minimum distribution out, and you'll get a check from Madison. Madison will report to the IRS what the RMD was. If you have a Roth IRA, there is no required minimum distribution. You can let that ride. So that's interesting for a lot of folks if they want to strategize, before their 70 and a half birthday, they want to convert to Roth and not have any more distributions. That's one way they could do it.
Well, I got to tell you, my dad is 71, and he is just as he looks like he's 50 to me. I mean, he's playing racquetball every day. And I was thinking, gosh, but he didn't need to take any money until he's like 95, the way he's going. So you never know. So, Jay, I got to tell you again. I don't want to make you blush here, but I want to thank you so much. You've got such great energy, and you really simplify this for us. And my last question to you that I'd like to close with, is there anything that we haven't covered today that someone should know when they're going to set up a self-directed IRA? Is there any key piece of the puzzle that they need to look out for, or any key benefit that we haven't covered today?
It's a great question, Stephan. For everyone's case, it's different, and I appreciate the opportunity to be here and to share whatever I've learned and just help people become more self-sufficient. It's really going to be, I think, an important thing to deal with everyone's situation differently. Yeah. Because we're all unique individuals. We've covered, I think, pretty much everything that most people in general need to know. But as always, when a person calls me and I sit down and I hear about their situation, I really want to know, not to be prying, but I really want to just know more. I want to know, what's the situation? What are you doing up until now? What do you have? What are your different accounts? Because now I get to see the whole picture, and I get to ask questions that help them help themselves, and then I can recommend whatever's best for them. So, in general, the best thing that I would say that maybe we haven't touched on enough that maybe would be helpful, go to the websites, learn as much as you can. We've put purposely, we've put a ton of information on there to educate our potential clients and our current clients, actually. So, anybody who wants to learn, it's a great place to go. Broadfinancial.com has put a lot of effort and time to making our website, very easy to read and also very informative. So I think you'll appreciate that information, whatever we have there. If there's something you just want a quick answer to, or you just want to get into it and learn more specifically from us, please give us a call. We'd be more than happy to help.
That's awesome. And guys, you can see I put the number up on the screen again. For those of you that didn't hear on the recorded portion, Jay personally is going to talk with all of you, so we're hoping that we can bombard him and make him regret that. But it's 800-395-5200, 800-395-5200. Your situation is always, once he communicates with you, finds out you might be 64 and you might have a medical issue perhaps to where you really need an XYZ number of cash flow to survive. You might be 76 and maybe you don't need any cash flow just because you've got a business that's providing all your bills, so you just want to let it ride. It's going to be different depending on where you're at, or you might be 27 and just looking to start out. Who knows? So he'll be able to customize it to you and really educate you on your specific situation. I know that's what's really important to him. And again, guys, this has been a lot of fun. I really want to thank all of you for being with us today, taking the time. I hope you enjoyed it as much as I did. Jay, I want to thank you so much again for taking the time. And, you know, I hope that we get to do one of these again in the future soon.
Oh, I'm excited. Thank you so much. It was a great honor, and you know, appreciate very much the opportunity, Stephan, to share the stage with you and all the good work that you're doing. And certainly, everyone. I hope we were able to help whoever was on the webinar today.
Sounds good, guys. Well, everyone have a great remainder of your evening, and we'll hope to see you on the next one. Take care.
Okay. Take care now.